Let's now go to Michelle Ong at the Philippine Stock Exchange for a preview of today's trade. Hi, Mimi. How are we looking set up for the day?
Hi, Mikey. Well, Philippine shares jumping off from 72.22. We were down by 0.75% yesterday. Value turnover was at 4.2 billion pesos. The downtrend yesterday was at the back of net foreign selling to the tune of 677 million pesos. Joining us now from our Rockwell studio is Mr. Deanno Basas, President of the Fund Managers Association of the Philippines. Good morning, Deanno. Thanks for joining us.
Morning. Thanks for having me here.
Great. So, Deanno, well, we just saw what many are describing as the most aggressive interest rate increase in Philippine history in 18 years. Is this shaking the faith of local fund managers like yourself?
I think it's really a function of what we're seeing in terms of inflation. So what we on the fund management side are doing is keeping track of what's going on, seeing how inflation is developing in response to the rate hikes, and the authorities will be calibrating their moves moving forward as they see the effect of their moves on inflation in the next few months. I think what everyone has to kind of keep in mind is that policy hikes have a lagged effect on the economy, and it takes some time for it to take effect. So that is something I think that needs to be kept in mind when thinking about the future steps of the central bank.
So what's the outlook for the inflation on your end? Because everyone's expecting that the 6.4% is not over. It's not the peak, that we could actually peak at 7.4%. If that actually happens, what will fund managers be doing? How would you be positioning yourselves for this kind of outlook?
I think if you look at the forecast for the latest inflation, it's about 6.8%. So people, economists, and even the central bank is already expecting a higher print, and that's really a result of several factors. We had weather disturbances, we continue to have supply constraints, which are feeding into the inflation number. So there are people still expecting perhaps higher rates moving forward, above 7% in some forecasts, but again, it really depends on how the prices or inflation react to the recent moves. I think the other policy measures, the RIFE tarification, will come into play, and that's something that has to be kept in mind. For fund managers, I think more or less everyone is in a wait-and-see attitude. For those who have adjusted portfolios, I think they're standing pat, and for those who have not adjusted portfolios, I think it's at a point where it's a little bit too late to be doing any drastic moves. So fund managers, I think, are awaiting the numbers and seeing if there is still a continued trend of inflation moving upwards.
You know, a lot of people are blaming inflation for eating up the value of fixed income bonds. Philippine bonds were the biggest losers in September. After us would, of course, be Switzerland, US, Canada, the UK. What are your expectations when it comes to demand for bonds?
Well, as I mentioned, people are in a wait-and-see attitude. So the interest of the market will be quite tepid, I think. However, if you look at it from a long-run perspective, what's happening now is an adjustment. It's an adjustment from very, very low levels of inflation that we had over the past few years into a sort of more normal level of inflation. And if you look at it from a longer-term perspective, it actually does offer opportunities for investors. For example, rates have adjusted to the point that 5-year levels are now near 7%. And I don't think we've seen those levels in quite a while. So if you take the long view, I think you will see some opportunities in the market. And once inflation sort of settles down and longer run things normalize, the opportunities that we're seeing now are things I think investors should be taking advantage of.
So Deanno, what do you tell your clients? How do they make money out of a market like this? The stock market is down, the peso is down. How do we make money? How do we win?
It's a common saying, right? You invest when no one wants to invest, and I think for fixed income, if your money is still in cash, it's worthwhile investing. Worthwhile investing in the short-term part of the curve and even the long-term part of the curve if you take the long-term view. If your money is in cash, investing it in time deposit now gives you 4.5% for 1 month, 2 month, 3 month terms. If you buy T-bills, you make 5.5% for 1 year. And if you go longer, government securities, you can earn up to 6-7%. So there are opportunities, and I think because the adjustment is quite abrupt, it surprises people. But I think at this point, because a big part of the adjustment in terms of interest rates, I think, is done, it's probably time to start moving back into fixed income. Especially if you look into next year, the forecast of the central bank is about 4.3% average for next year. Having bonds which offer about 6-7% gives you a good real rate of return on your investment.
Okay, asset allocation, how would you recommend? How many percent should go to cash? How much should go to stocks? And how much should be in fixed income?
Asset allocation is really a function of your risk profile as an investor. Right now, generally speaking though, I would still keep a certain portion in cash, maybe use that as powder, dry powder to go into the markets both on the fixed income and on the equity markets. But I would not at this point recommend to have too much cash, given where the levels are on fixed income and where the levels are on the stock market. I think in the short run, there will be volatility, but if you keep the long game in mind, I think the levels that we're at now are pretty interesting levels and good for long-term investors.
Okay, on that note, thank you very much, Deanno, for joining us this morning.
Thank you. Thank you for having me.
Mikey, over to you.
Deanno, just a quick question on foreign exchange. Okay, so Deanno, sentiments and technicals seem to be stacked against the peso. The Fitch Group has even lowered its end 2018 and 2019 forecast for the exchange from 54 for 2018 and 2018 to 54.80, and for 2019 their end target from 54 to 56.33. What's your view on the foreign exchange?
On the foreign exchange, we think that there will continue to be some weakness in the peso. I think from, if you think of it from an economic perspective, it's really a function of more dollar demand as opposed to dollar supply. And that's a function also of the build and the infrastructure push and even the private sector push, right? We're importing more capital goods to support the infrastructure build and the expansion that we're doing locally, and that's putting pressure on the currency. If you take a look though at where we've come from, we've depreciated about 10%, 8-10% from start of the year. And if you look also at how the interest rate differentials have started to move, the rates or yields on peso assets have a good premium against dollar assets. So what I'm trying to say is there is still continued weakness. However, given the levels that we're at now, the interest rate differentials that we have of the peso against the dollar will probably temper further depreciation of the currency. Of course, there's also management of the currency. The central bank has also instituted certain reforms, such as the currency rate protection program, to help temper the volatility. So we could expect some more weakness, but I don't expect it to be moving another 5-10%, maybe another 1-3%, depending on how the dollar demand supply dynamics pan out.
Okay, thank you for your time this morning, Deanno.
Thank you again.
Up next, the SSS